We now move to the sovereign creditworthiness and financial stability, international perspective. In this topic, we'll look at the factors leading to the economic crisis uh, during the period 2000 to 2007. The three factors that contributed to the global nature of the crisis, and we'll look at them. Will also look at specific ways risk can be transmitted from one financial sector to sovereign and from sovereign to the financial sector. It's critical to understand that the fiscal soundness of a sovereign government is an important prerequisite for effective functioning of the financial system. Now, while a well-functioning global financial system is equally important to the financial health of the sovereign, it is key to recognize that certain buffers are necessary in order to maintain sovereign risk-free status, where the creditworthiness of the sovereign is paramount in maintaining or reinstating investor confidence. Let's understand how the economic crisis conditions grew. I said that there are three initial conditions that help the spread of economic crisis among sovereign. And the crisis originated in the financial sector but rapidly spread to sovereign when sovereign solvency was one of the major concerns. First, banking system of most of the developed economies had insufficient capital at the outset of the crisis. The very liquid marketplace prior to the crisis allowed many financial institutions to take increasingly large risks with minimum imposed limits. As a result, those institutes had inadequate capital and were over leveraged. And there were also large maturity and currency mismatches. These risks left the institution exposed to liquidity crunch effect of the crisis as well as negative feedback between banks and the sovereigns. Second, the sovereigns did not build up sufficient financial cushion during the boom period prior to the crisis. The credit boom period, which lasted from 2000 to 2007, led to an unstable rise in revenues that created an environment of false confidence that left sovereign ill prepared to face economic shocks. While sovereign government quickly provided funds to recapitalize their financial system and to enable discretionary financial stimulus, they lacked the depth of reserves to fully fund all of the long-term obligations. Third, the very high level of integration in global financial system among sovereign and financial institutions exacerbated the crisis. While the level of interconnectedness in the global market greatly aid global finance integration, a risk can become pronounced in the absence of sufficient capital, liquidity or resilience. Financial sector and sovereign risk. Now we'll understand how risk could be transmitted, and we'll look at three ways in which risk could be transmitted. So, despite seemingly prudent fiscal and financial policy by European sovereign government prior to the financial crisis, the risk from the financial sector materially affected sovereign governments. There were three primary ways in which risk of the financial sector can be transmitted to sovereigns. First, credit boom provide one-time abnormal boost to the government fiscal balances over a regular cycle of expansions. This may not only hide weakness of the underlying finance system but also make the government fiscal position seem stronger than it is. As a result, a government may continue spending that would prove unsustainable in a long term. Second, lending constraint due to weak financial institution balance sheets and macroeconomic cost that could further weaken the fiscal cost. In the absence of adequate capital and liquidity buffers of the financial institution, credit constraints can tighten beyond a decline in borrowers' quality, cutting off the supply of credit. As a result, economic activity and tax revenues would decline and government expenditure would rise, leading to higher public sector deficit, reducing the creditworthiness of the sovereign. And this is what happened in Spain. Third, when significant financial institutions are on the brink of bankruptcy, sovereign may be forced to provide them with financial support or bailout support to liquidity. And this could be assistance, direct capital injection, asset purchase, or debt guarantee in order to provide overall macroeconomic stability. These actions increase both explicit and implicit obligation of the sovereign and were prominently observed in Ireland in 2008 to 2011. Now describe 5 ways in which sovereign risk are transmitted to the financial sector. So rather than weakness of the financial sector affecting the sovereign risk can also affect the financial sector. We'll look at 5 ways in which sovereign can be transmitted to the financial sector. The first is portfolio exposure, funding condition, sovereign capacity to assist, crowding out private sector debt, and fiscal consolidation. So this crowding effect was also seen in economics in the CFA exam. So since banks compete with government for funding, sovereign debt may crowd out private sector debt by increasing the cost and reducing the availability of bank funding. This is especially pronounced for sovereign at the risk of losing their risk-free rating. Now, the portfolio exposure. Financial institution can be exposed to both domestic and sovereign risk through their holding of sovereign bonds. Financial institution includes bank exhibit a strong bias on holding domestic sovereign portfolios. In European Union, bank held an estimate of 85% of government bond, and financial institution in countries with higher public debt tend to hold a greater percent of government bond. Financial institutions, especially those active internationally, are also vulnerable to foreign sovereign risks through their holding of government bond portfolio. Funding condition. Banks frequently use sovereign securities as collateral in wholesale funding repos covered repo market. As the sovereign risk increases, the availability of eligible collateral declines, reducing banks' ability to fund. It was estimated that 30% or 50% of the bond spread in 2010 represent sovereign risk. Sovereign capacity to assess. Sovereign that are perceived by financial markets weaker as have reduced capacity to provide assistance to banks. As a result of second quarter of 2011, bank received a 2 to 5 notch upgrade by rating agency based on previous sovereign support. This changed in the second half of 2000, when the decline of sovereign creditworthiness of Greece, Italy, and Portugal led to a drop in their rating. Fiscal consolidation. A loss of market confidence in sovereign debt may lead to fiscal consolidation. In short term, the risks are weak aggregate demand and weak activity that pressure credit quality and bank profitability. The benefits, however, include long-term fiscal consolidation. Now let's look at EU banks and sovereign during 2002 to 2007. The banking activity and the sovereign in the European Union during 2002 to 2007 period led to the economic crisis. During 2002 to 2007 period preceding the economic crisis, there was little indication that market participants were aware of underlying economic and financial risk. Sovereign debt to GDP ratio of economic union countries were within sustainable level, bond yields were low, and government ratings remained high. Bank profitability continued to increase each year, and bank rating also remained high despite of ongoing increase in leverage. In fact, the global integration of financial system sustained high level of leverage as system financed the borrowing and spending of European government, Greece and Italy, and the finance provided domestic credit expansion like Spain and Ireland. The Eurozone bank constituted of some of the largest suppliers of credit both within the Eurozone and internationally. These banks were the main lender to public sector debt for Greece and Italy, and to the banking sector, Spain and Ireland. So it's quite interesting. If we look at the public sector debt, we are talking about Greece and Italy. Whereas if we are talking about the banking sector debt, we talk about the Spain and Ireland, and became the largest lender to riskier foreign government, including Italy, Spain and Greece. In contrast, foreign banks outside the Eurozone continued to primarily lend to less risky Eurozone area like Germany and France. Over the time, Eurozone banks became heavily dependent on their access to cheap short-term funding. As a result, did not build up adequate liquidity reserve. When liquidity dried up in early 2010 and later in early 2000 and also in early 2007, the volume of unsecured transaction declined by cost to half, while secured transaction continued to be the majority of cash deal. The first major warning signal that the market failed to recognize was a significant rise in private credit to GDP ratios and real estate prices above their long-term trend. This indicator is often considered the most important warning of accumulating systematic risk and predictor of a looming credit crisis. In spite of the warning, the bank continued to increase their leverage, satisfying the key initial condition of the crisis that the bank were increasing their leverage. Two additional temporary effects also contributed to the crisis. First, business cycle continued to expand, lending to higher public sector account balances with the fiscal balances of several countries exceeding the cyclical adjusting balances of most of the OECD. Second, the increase in asset and real estate prices caused government to spend freely. As a result, second key initial condition of the crisis was also specified. Looking back, it is evident that the financial stability and fiscal authority should have been aware that banks had been maintaining insufficient capital that proved unsustainable, and as a result, they should have adopted measure at the first sign of the crisis. This would have prevented the occurrence of second initial crisis condition. Now, economic condition leading up to 2012. We'll look at the activities of bank and sovereign in the European Union during the economic crisis. We'll also describe how risks were transmitted among banks and sovereign in the European Union during the economic crisis. So, following the first sign of crisis in summer 2007 until summer 2008, financial markets were primarily concerned with credit risk of individual financial institutions rather than creditworthiness of sovereign specific sovereigns. This resulted in the credit default swap spread of the bank increasing significantly more than sovereign CDS spread. In the fall of 2000, however, a number of sovereign governments were forced to provide financial support to their struggling banking sector, and with the supporting constituting a large portion of GDP, reaching to as high as 55% of GDP. Without adequate financial buffer, which could have built up during previous expansionary cycle, the sizable support package called sovereign creditworthiness into question, and as a result, most sovereign CDS rose dramatically while the bank CDS spread declined. Despite negative correlation, the bank and sovereign CDS both rose in certain countries, including Greece and Italy. Interestingly, banking system, especially in the eurozone, began to rebalance their portfolio toward public sector by increasing their foreign portfolio exposure to both safe for foreign and riskier European or sovereign, including Greece, Italy, Spain, Ireland. Following the fourth quarter of 2009, however, the sign of Eurozone area problem became much more evident, resulting in positive correlation and a simultaneous rise in both banks and sovereign CDS spread. Following this period, large banks began to divest riskier sovereign, including Greece, Italy, Portugal, Spain, and rebalance their portfolio towards safer sovereign, including United States and Germany. The financial crisis resulted in a material decline in banks' foreign claim on sovereign, resulting in a decline in public sector debt of Greece, Italy, Portugal, Spain of over 40% since late 2009 by the end of 2011. There were three reasons for the decline. First, that the bank already marked down the value of sovereign debt to the market value of their balance sheet or provisions against future losses. Second, bank likely allowed some of the sovereign debt to mature without replacing it. Third, bank may have already sold a portion of foreign government debt to European Central Bank or to domestic of the sovereign governments. These three factors help explain the decline in claims on the public sector of some of the more riskier sovereign, although it is difficult to attribute the decline to any specific factor. Between the first quarter of 2010 and the first quarter of 2011, internationally claims on public sector debt of Greece, Ireland, Portugal declined by 56% under the ECB security market program. Nevertheless, the decline during this period in the claims on several other risky sovereigns, including Italy, which was down by 42%, and Spain, which was down by 12%, cannot be explained under this factor, as ECB purchase did not begin until 2001. Despite the decline in exposure to risky European sovereign debt as a mid 2001, bank exposure to foreign public sector debt remained elevated, including close to 40% of the combined exposure of Tier 1 capital of Germany, France, Belgium. Other exposure to individual sovereign debt ranged from 80%, like Italy, US, Germany, to 240% in Switzerland, Belgium, and Canada. In addition, the foreign portfolio of euro area banks remained concentrated in riskier eurozone sovereign debt, as banks continued to underweight less risky sovereigns and overweight risky ones. So less risky sovereigns were Germany and France, and riskier were Belgium, Portugal, Italy, and Spain. These portfolios remained highly concentrated in the debt of their own sovereign, often exceeding 100% of their tier 1 capital. This characteristic of bank in both safer and riskier countries. Now let's look at economic condition in 2012 and policy recommendation. Economic condition of the European financial sector in 2010, and some possible policy explanation can help us understand how they would mitigate the spread of future crises. By 2012, global financial system has become more strongly integrated. This interconnectedness requires a prudent approach to government finances and financial stability. And policymakers need to factor in spillover effect in the decision, as decisions in one jurisdiction can affect economic and financial development in other through chain reaction. One of the key tasks in 2012 and beyond is to rebuild public confidence in sovereign in order to restore the risk-free status of the bond. This was particularly important as the traditional approach to risk weighted is to assign a zero weight to sovereign, which is difficult to sustain even if sovereign risk does not improve. Instead, it is more prudent to assign a potential risk weight other than zero. This is clearly seen in the requirement of Basel 2 and 3, which requires bank to use granular approach in distinguishing between sovereign risk and applying a higher risk weighting for higher sovereign risk. Basel 3 regulation also set a floor of 3% on the leverage ratio on the capital backing of the sovereign holding. In summary, government need to strive to rebuild confidence through multiple steps. In short term, the role of the government is to implement actions to reduce their indebtedness by fiscal consolidation, timely reform, financial backdrops in order to maintain investor confidence. In the long term, government needs to provide a counter-cyclic policy to approach through implementation of automatic stabilizer or discretionary action. As a result, government need to remain creditworthy even during the timing of stress by building up adequate financial buffer during the economic booms. Now let's quickly revise what we have been talking about. So by 2012, the global financial system has become integrated, and there were several policy recommendations to mitigate spread of future crises. Regulations should set a floor on leverage ratio. Banks should apply granular approach and distinguish among sovereign risk, applying a higher risk weightage for higher risk sovereigns. In short term, government need to implement action to reduce their higher indebtedness by fiscal consolidation, timely reforms, and financial backstopping in order to maintain investor confidence. In the long term, government should provide a counter-cyclical policy approach in order to remain creditworthy. Let's understand some of the questions. So what are the recommendation and what they have talked about? So the recommendation is that the bank should apply granular approach in distinguishing risk among sovereign risk, applying a higher risk weighting for higher risk in sovereign. In long term, government need to provide a counter-cyclical approach in order to remain creditworthy. And in short term, it's fiscal consolidation, timely reform, and financial backstop. So that was it for the topic of sovereign creditworthiness and financial stability and international perspective. Hope this was useful and added something to your current knowledge base.